Cryptocurrency. It's everywhere, isn't it? In the news, conversations, maybe even ads popping up.
Absolutely. It's hard to miss.
Yeah, and you hear all this buzz, but
Right.
trying to figure out what it actually is, what its real value might be, if any, it can feel, well, overwhelming, like you need a special decoder ring or something.
That's a very common feeling. The whole crypto space has just exploded, and there's so much jargon, so much information, it's tough to cut through the noise.
Exactly. So that's what we're trying to do in this deep dive. We want to sort of unpack cryptocurrency for you, the listener. We've looked at, the original papers, financial crime reports, expert opinions, the whole lot, trying to get a clear, balanced view. Think of this as your guide to getting a real handle on it.
Right. Our mission today is pretty straightforward. Give you an easy-to-understand guide. We'll cover where it came from, what it actually is, the big debate about its value.
How it works, the nuts and bolts.
Yeah, the mechanics, the risks, and there are definitely risks, how it sometimes gets tangled up with illegal stuff, what the experts are saying, and, why it might face some serious hurdles down the road. The goal is to give you enough solid info to decide for yourself if this is something you want to engage with, or maybe keep at arm's length.
Okay, sounds like a plan. Let's start right at the beginning then, the genesis. Where did this whole idea come from?
Well, the core concept for what became Bitcoin, the first big one, came from a 2008 white paper. It was titled A Peer-to-Peer Electronic Cash System.
Peer-to-peer electronic cash.
Okay. The main goal was to figure out how to do online payments directly between two people without needing a trusted third party, like a bank.
Cutting out the middleman.
Exactly. And the big technical hurdle they solved was something called the double spending problem. How do you stop someone from spending the same digital coin twice?
Right, because you could just copy digital information, couldn't you?
Potentially, yes. The solution proposed was this peer-to-peer network using something called proof of work. Basically, it makes participants use computing power to validate transactions and add them to a shared public ledger, the blockchain. This ledger becomes a history that's really, really hard to tamper with.
How hard?
Well, the idea is that as long as honest participants control more than half the network's computing power, it's practically impossible for an attacker to rewrite the transaction history. It would just cost too much computationally.
Okay, so it's secured by collective computing effort, in a way.
That's a good way to put it. And the network itself was designed to be decentralized and pretty unstructured. Nodes, the computers in the network, don't need IDs. Messages just get passed along on a best effort basis.
So anyone can join or leave?
Yep. Nodes can drop off and come back online whenever. When they rejoin, they just look for the longest proof of work chain that's the accepted history of what happened while they were gone.
And this proof of work is how everyone agrees on what transactions are valid.
Correct. Nodes vote with their CPU power, essentially. They accept valid blocks by working to extend them, and they reject invalid ones by simply refusing to work on them. It's consensus through computation.
And Bitcoin was the first big cryptocurrency built on this, right? Launched back in
2009, yes. Bitcoin was the first real-world application of this blockchain concept. And its timing, right after the 2008 financial crisis, probably fueled a lot of interest in, alternatives to the traditional system.
It was created by someone or some group called Satoshi Nakamoto. Still anonymous.
Still anonymous. That name is a pseudonym, and who's actually behind it remains one of the biggest mysteries in tech.
Okay, so that's the origin story. Let's clarify again. In simple terms, what is cryptocurrency?
At its heart, it's digital or virtual money. The key thing is that it's secured using cryptography complex codes rather than by a central authority.
And blockchain is the technology underneath it.
Often, yes. Blockchain is the distributed ledger technology we just talked about. Think of it like a shared digital spreadsheet or database that's copied across countless computers. Okay. It stores information in blocks, and each new block is cryptographically linked to the one before it, containing a timestamp and a batch of recent transactions. This chain makes it transparent. People can see the transactions, but also tamper-resistant.
So like a digital chain of records where each link locks the one before it.
Exactly. And for many cryptocurrencies, like Bitcoin, a crucial feature is decentralization. No single bank, company, or government controls the network.
Which leads to that immutability idea.
Precisely. Once a transaction is confirmed and added to a decentralized blockchain, changing it is, for all practical purposes, impossible. It's permanent.
That's a really different model from traditional finance.
It absolutely is. These crypto systems operate outside of, geography, politics, normal legal systems. Their security relies purely on the math, the cryptography.
And what about privacy? You mentioned pseudonymity.
Right. You have a public address, kind of like an account number, for receiving funds. But that address isn't automatically linked to your real-world identity like a bank account is. So it offers pseudonymity. But, and this is important, the transactions themselves are usually public on the blockchain. They can be traced, even if connecting them to a specific person is harder.
Okay, so not truly anonymous, but pseudonymous. Got it. Now, the $1 million question, or maybe the $0 question, what's it actually worth? Is there real value here?
The value proposition. That's it. Well, that's probably the most debated aspect. For cryptocurrencies like Bitcoin or Ethereum, the value is largely determined by market supply and demand.
So pure market forces. More buyers, price goes up. More sellers, price goes down.
Pretty much, yeah. Like stocks or commodities in that sense. If people want it, it has value. If they don't, it doesn't.
But unlike, say, a stock that represents ownership in a company producing things.
Exactly. This leads to the criticism that they lack intrinsic value. But then you have stablecoins.
Stablecoins. How are they different?
Stablecoins are designed specifically to minimize that wild price volatility. They try to peg their value to something more stable, usually a fiat currency like the US dollar, or sometimes commodities like gold.
So one stablecoin might always aim to be worth $1.
That's the goal, yes. There are different ways they try to achieve this. Some, like USDC or USDT, are fiat-backed. They claim to hold reserves actual dollars or equivalent assets to back each coin in circulation.
Claim to? Is there controversy there?
There has been, yes. Questions about whether the reserves are fully backed and transparent have definitely come up. Then there are other types, like crypto-backed ones that use other cryptos as collateral, or algorithmic stablecoins that use code to manage supply, even commodity-backed ones.
And the idea behind stablecoins is
What?
to make crypto more usable for actual payments.
Precisely. They aim to combine the stability people are used to with fiat money, with the potential benefits of crypto tech, like faster, cheaper cross-border payments. But it's worth noting, even stablecoins aren't totally immune. Their stability can still be rocked by big events in the wider crypto market, not just things happening in the traditional economy.
So even the stable ones carry crypto market risk. And back to the non-stable ones, like Bitcoin. The argument is they lack intrinsic value compared to government money or gold.
That's a major argument from skeptics, yes. Fiat money has value because governments say it does its legal tender. Gold has industrial uses and thousands of years of history as a store of value. Critics argue that many cryptos don't have that underlying foundation, so their price is driven more by sentiment, speculation, hype, which explains the intense volatility.
Okay, that makes sense. Let's switch gears to the mechanics. How does a transaction actually happen? How does it get verified and recorded?
Right, the nuts and bolts. So, you initiate a transaction sending crypto from your address to someone else's. This gets broadcast to the network.
To all those nodes we talked about.
Exactly. Then, network participants, often called miners or validators, depending on the system, bundle these transactions into blocks. They then work to validate the block, usually through that proof of work process or sometimes other methods like proof of stake.
Which requires consensus.
Yes, a majority of the network participants need to agree that the transactions in the block are valid according to the rules. Once consensus is reached, the block is added to the existing blockchain.
And then it's set in stone. Immutable.
Correct. Once it's on the chain, it can't be deleted or changed. Only new blocks adding new transactions can be appended.
You mentioned mining again. Can we break that down a bit more? What are miners actually doing?
Sure. So new transactions are flying around the network. Miners grab a bunch of these unconfirmed transactions.
Okay.
They put them into a potential new block. Then comes the work part in proof of work. They use powerful computers to solve a really complex mathematical puzzle that's linked to that block's data.
Like a race.
Kind of, yeah. The first miner to find the solution, the proof, gets to add their block to the chain. They broadcast the solution and the block to the network.
And everyone else checks their work.
Yep. Other nodes quickly verify the solution is correct and the transactions inside are valid. If it all checks out, they accept the block, add it to their copy of the blockchain, and the miner who found the solution usually gets a reward.
A reward in the cryptocurrency itself.
Exactly.
Yeah.
That's typically how new coins are created and enter circulation, and it's the incentive for miners to spend the electricity and computing power needed to secure the network.
which I imagine can be a lot of electricity.
It can be, yes. Especially for proof-of-work systems like Bitcoin. That energy consumption is a whole other area of debate.
Understood. And securing individual transactions, you mentioned public and private keys?
Right. Every user has a pair of cryptographic keys. The public key is like your address. You share it to receive funds. The private key is secret, like a password or a digital signature. You use it to authorize sending transactions from your address.
So never share your private key.
Absolutely critical. Losing it means losing your crypto. Sharing it means someone else can steal it.
Got it. And what about smart contracts? Hear that term a lot, too.
Smart contracts are basically pieces of code stored on the blockchain. They automatically execute the terms of an agreement when certain conditions are met. So instead of needing a lawyer or intermediary, the code itself enforces the contract. Think of it like a digital vending machine. Put in crypto input, get a digital asset or service output, all based on pre-programmed rules.
Interesting. Okay. Seems powerful, but also complex. Let's talk risks. We touched on volatility, but what else should people be aware of?
Oh, there are quite a few. Volatility is the big one for sure, making it a risky place to park your savings. Prices can plummet incredibly fast.
We've definitely seen those crashes happen.
Yeah, and they're often fueled by speculation, hype, and that FOMO fear of missing out, which creates bubbles that eventually pop. Then there's the risk of outright scams. Unregistered investments are a big red flag. Ponzi schemes are unfortunately common in the crypto space.
How can you spot a potential Ponzi scheme?
Look out for promises of guaranteed high returns with little risk. That's classic. Also, pressure to recruit new investors, complexity or secrecy around how the money is actually made, issues with paperwork or registration, and difficulty withdrawing your money if it seems too good to be true.
It probably is. Right. What about cyber threats, hacking, and theft?
Huge risk. Ransomware is a major one. Criminals lock your files and demand crypto payment, like we've seen with groups like Reseda.
Nasty stuff.
Then there's malware designed specifically to steal crypto from your digital wallet. The Pony botnet was notorious for that. And cryptojacking, where hackers secretly use your computer's power to mine crypto for themselves.
So they steal your resources.
Exactly. Slows down your machine, runs up your electric bill. Add to that exit scams, where a whole project just vanishes with everyone's money. Plus, the rules and regulations are still evolving globally, creating uncertainty. And, as we said, losing your private keys means your funds are gone forever. No bank can help you reset your password. Finally, there are still technical questions about whether blockchains can scale up to handle massive global usage without becoming less decentralized or less secure.
Okay, that's a sobering list of risks. Let's move to something related but even darker. The use of crypto for illegal activities. Money laundering comes up a lot.
Unfortunately, yes. The pseudonymity and borderless nature of some cryptocurrencies do make them attractive for criminals trying to hide and move illicit funds. Crypto money laundering isn't fundamentally different from traditional methods. The goal is the same. Take dirty money from crime, run it through transactions to make it look legitimate, clean, and then integrate it back into the financial system or use it.
How do they do that with crypto?
They move the tokens through a whole series of different digital addresses, maybe across different blockchains, trying to obscure the original source. They might use mixers or tumblers.
Mixers, what are those?
Services that pool together crypto from many users and mix it up, then send it out to new addresses. It's designed to break the chain of traceability. Though forensic tools are getting better at unmixing some of these.
I see. So they try to muddy the waters.
Exactly. They might also use exchanges with weak anti-money laundering, AML checks, or nested services within larger platforms. Over-the-counter OTC brokers who arrange large, private trades can also be exploited. And using lots of accounts, splitting funds, creating complex peel chains, it's all about layering and obfuscation.
Are there prominent examples where this has happened?
Oh, definitely. Silk Road, the old darknet marketplace, was one of the first big ones using Bitcoin for illegal sales. Law enforcement seized a lot of crypto there. Bitfinex, the exchange, has been linked to laundering schemes. The Plus token Ponzi scheme involved huge amounts of laundered crypto.
And didn't authorities recover funds from a big exchange hack years later?
Yes, the Bitfinex hack from 2016. Investigators managed to follow the stolen funds through a complex web of transactions and seized billions worth years later. It shows tracing is possible, even if difficult. We also saw the case with Bitslotto, an exchange allegedly used heavily by ransomware gangs and darknet markets because of its poor compliance.
So it's an ongoing battle between criminals and law enforcement in the crypto space.
Absolutely. And it's not just laundering. FinCEN, the U.S. Financial Crimes Agency, put out alerts about pig butchering scams.
Pig butchering, that sounds awful.
It is. It's a type of investment fraud, often starting with romance scams. Fraudsters build trust, sometimes over months, then convince victims to invest crypto in fake platforms, fattening the pig before disappearing with the money. We've seen reports of people losing huge sums this way. And of course, basic drug trafficking on the dark web still heavily relies on crypto for payments.
It's clear there's a significant dark side. Okay, let's bring in the experts. What's the general feeling among economists, financial analysts, tech gurus about crypto's future?
Well, it's really divided. You have quite a few prominent skeptics. Economist Kenneth Rogoff, for example, has suggested Bitcoin's value could eventually collapse due to its limited use and inefficiency. He's talked about it potentially falling way, way down.
That's a strong warning.
It is. The European Central Bank has also been critical, basically saying cryptocurrencies don't work well as money, and they bring instability. A common view among these skeptics is that as traditional finance gets better with digital technology, maybe even government-backed digital currencies.
Central bank digital currencies, or CBDCs.
Exactly. As those develop, the argument goes, maybe decentralized cryptocurrencies will just lose their relevance. Why use Bitcoin if you have a super efficient government-backed digital dollar or euro?
That makes sense as a potential challenge.
But then on the other side, you have passionate believers, especially within the crypto industry itself. They see Bitcoin, for instance, as having a guaranteed bright future. They believe the technology is revolutionary.
So complete opposites.
Pretty much. However, one area with broader agreement is the potential of the underlying technology blockchain. Many experts, even crypto skeptics, see value in blockchain for things beyond currency, like supply chain tracking, secure record keeping, etc. The debate is more about whether these specific volatile cryptocurrencies built on blockchain are the right long-term solution for money.
Okay, so the tech might be useful, but the current cryptocurrencies face questions, which leads nicely to our last point. Why might crypto, as we know it now, ultimately stumble or fail to become truly mainstream and stable?
There are several core reasons we've touched on. First, that extreme economic instability. The volatility just makes it impractical as a reliable store of value or everyday payment method for most people and businesses.
Hard to budget if your money's value swings 20% in a day.
Impossible. Second, human psychology plays a huge part. FOMO, greed, the belief you can beat the market, these drive speculative bubbles and crashes, making the whole ecosystem unstable.
The hype cycle.
Exactly. Third, those technical scaling challenges. Can blockchains really handle billions of transactions securely and stay decentralized? Many proposed solutions involve trade-offs, like centralizing parts of the system, which kind of defeats the original purpose for some.
Right.
Fourth, regulation. Governments are stepping in, like the EU's MiCA framework. While aiming for protection, these rules could restrict crypto's usage or make it less attractive, potentially stifling its decentralized nature.
So regulation is a double-edged sword for crypto.
It definitely could be. And finally, as mentioned, the rise of potential government-backed digital currencies could simply offer a more stable, integrated alternative, reducing the need or desire for private cryptocurrencies for many users.
So a combination of economic, psychological, technical, and regulatory hurdles.
That sums it up well. While the innovation is undeniable, these are significant obstacles to overcome for widespread, stable adoption as actual currency.
Okay, this has been really illuminating. We've gone from the Satoshi white paper and the dream of peer-to-peer cash through blockchain mechanics, the whole value debate, how mining and transactions work, the very real risks in illicit uses, heard the divided expert views, and looked at why this whole experiment might face roadblocks.
Quite the journey.
Yeah. Hopefully this deep dive has armed you, the listener, with a much clearer picture, cutting through some of that hype and complexity. The idea wasn't to tell you whether to invest or not, but to give you the tools to think critically about it yourself.
And maybe a final thought to leave you with. Considering everything we've discussed, the potential, the pitfalls, the divided opinions, what kind of fundamental shift, either in our financial systems or in the technology itself, would actually need to happen for cryptocurrency to truly become a stable, widely accepted global currency or store of value, something beyond just price speculation?
That's a big question. Definitely something to mull over.
Indeed. Thanks for joining us on this deep dive.